Imagine you're ordering dinner. Your total comes to $41. But instead of paying all at once, you choose an option at checkout to make 4 payments of $10.40 over 6 weeks, with absolutely zero interest. This chart shows the adoption of buy now, pay later services since 2019. You can see how demand has spiked. Overall transaction volume has multiplied 20 times in just a few years. And people are using these loans differently now. Accord users are financing everyday consumable purchases, like groceries. Which raises a rather obvious question. If millions of people are taking out these loans and paying exactly zero interest on their burrito bowls and groceries, how are the companies dominating the US market actually pulling in billions of dollars? The answer is that the cost of that free money isn't disappearing, it's being shifted. The entire model relies on a premium fee charged directly to the retailer. When you hit the Buy Now, Pay Later button, the provider pays the retailer the full amount the very next day. From that moment on, the lender takes on all the risk if you decide not to pay. This visual breakdown of a $41 purchase shows how providers cover that risk. Retailers pay the provider to offer the service, and sometimes that fee is a 5% slice of the total transaction value. That specific merchant charge makes up over 90% of the total income for some of the biggest platforms. Retailers are willing to hand over that margin because offering the option at checkout drives shoppers to actually finish their purchases. These companies aren't strictly operating as traditional consumer lenders. They are selling guaranteed checkout conversion to retailers at a premium price. But that original zero-interest e-commerce model is shifting. Lenders like Affirm have expanded into longer-term options, and today about 80% of their business carries interest. They are also aggressively moving off the internet and into brick-and-mortar stores. The goal is to secure direct partnerships to capture more of those lucrative merchant fees. You can see this scale with Klarna, which struck an exclusive deal to provide customer loans at Walmart through the retailer's fintech arm. Providers are even rolling out physical parts you can tap at the register, which industry executives estimate could effectively double their potential market size. By securing these in-store deals and offering longer, interest-bearing loans, Buy Now, Pay Later is moving out of the checkout window and building out a comprehensive alternative to everyday banking. As these loans cover more everyday spending, financial stress is starting to show among the expanding user base. A recent study released by the Consumer Financial Protection Bureau found that more than 2/3 of Buy Now, Pay Later loans went to borrowers with lower credit scores, and a separate LendingTree survey showed that 41. In 2024, the CFPB issued an interpretive rule that would subject these providers to the exact same regulations as credit card companies. But shifting political winds have stalled those plans. The new administration and the Department of Government Efficiency crippled the Consumer Protection Agency, which announced it will not prioritize enforcing the rule. Early on, industry executives confidently stated that the traditional credit card industry was going the way of the VHS tape. The reality is a bit more nuanced. Buy Now, Pay Later likely won't eradicate credit cards entirely, but it is successfully replacing them for millions of people and specific types of transactions. By bypassing traditional interest models and sidestepping federal oversight, these companies have built a parallel financial ecosystem, turning consumer debt into a frictionless, almost invisible part of our daily lives.